TCS has started the earnings season with a bang, and the numbers which had just come out a little while ago, they are way above street estimates. To talk about numbers, the way forward, and what is the global big picture, with great pleasure, let me now welcome on board the CEO of India's biggest IT company, N. Chandra. Chandra, fantastic to have you on ET Now. Thank you for joining us. You know, I've been waiting for this headline, and you've given me a headline today. As journalists, we are always on watch out for a headline that TCS has managed to beat industry estimates or analyst estimates for 2 quarters in a row. That's the headline for me. But what I want to understand from you is your understanding of how things have moved for the quarter gone by, both in terms of footfall and also in terms of client wins.
Because I think the important thing for me is how the metrics look. I think what is very nice about this quarter is the overall footprint. First, we have a very good dollar revenue growth after several quarters. It's a 3.7% dollar growth, which is the best in the last 6 quarters. Volume growth is healthy at 3.4%. Then we have an excellent business footprint because it's a very broad-based growth. And if you see a vertical like telecom, it has done exceptionally well, almost at 10%. And if you look at life sciences, if you look at manufacturing, utilities, travel, all of them have delivered excellent growth. The type of engagements are also excellent because front office transformations from a digital perspective, whether it is customer journeys or channel transformation or digital marketing from the front office perspective, from a business agility perspective, cloud transformation, including application as well as infrastructure, or from IoT perspective, sensor data analytics and business outcomes, which will give supply chain visibility, for example. So those are the kind of engagements that we have seen. And the business mix is very nice, with the consulting and the enterprise solutions also picking up momentum, over 6% this quarter. And all of this, together with a very strong performance on the HR side, our attrition numbers are one of the lowest in several quarters, maybe in the last 10 quarters, I would say. It's very, very healthy, a 12.5% attrition in the IT services space annualized LTM basis, which is very, very credible. And all of this have led to a very strong margin defense. As you know, it's a very tough quarter from a margin perspective, more than 200 basis points of impact, wage increase, and the rupee strengthening against most currencies. That's another 20 basis point headwind. We've been able to overcome that and execute it very strongly to deliver a 25.1% margin. So I think the footprint of the metrics is very nice.
Chandra, but if I look at your biggest vertical, which is the BFSI vertical, and if I look at the BFSI growth, if I compare your Q1 FY17 growth versus Q1 FY15 and 16 growth numbers, that growth number is not looking very impressive. And that is your big business, the 40% of the business which is not growing at historical growth rate.
That's a correct statement. There are multiple messages to look at there. First, I am rather happy that from a trend perspective it is in the right direction. If you look at the incremental revenue from BFSI in Q4 of FY16 and the incremental revenue from BFSI this quarter, it has increased. So that is a positive. And from a growth rate perspective also, that is a positive from a Q4 to Q1. Otherwise, you have a different message. And also, I think we should see it in light of all the macro that are happening. And though I have not had any specific client-specific issue to report, we need to watch this space a little bit carefully, because how the Brexit will play out and what will be the reaction of whether it is global banks or national banks or regional banks, European-based banks, UK-based banks, and other institutions is something that we have to watch out. The other positive message to take out is we have delivered a very strong performance in spite of BFSI delivering only 1.7% growth. That is a positive takeaway. So I think all of this have to be seen in perspective, and we can't take eyes off the ball. You've got to watch BFSI space. But I'm pretty happy that we have such a broad-based growth, and most of the industries are seeing good momentum.
So at a growth of 1.5% for the BFSI, we're looking at quarterly growth here. You're happy with the growth rate?
I think that directionally it is good.
Okay.
It is actually good. I mean, it is a tad low, definitely, compared to what you are used to in Q1.
Exactly.
In a Q1 quarter, it's definitely better than the 1.7% we have delivered. But having said that, it's incrementally it's better than Q4, and you've got to see it in light of everything that's going on. So you've got to watch this space a little bit carefully. But I also don't have any client-specific thing I've heard. I've been with clients, especially after the Brexit. And we have nothing to report at this point, but we've got to watch carefully.
Chandra, clearly Brexit is an extraordinary event, but the destination is 2 years away and you don't know what will happen in between. So one is what you will hear from the client, and second, what will happen to your delivery centers. So currently, what is the kind of delivery setup you have in UK?
See, I think the issue is not about 2 years or 1 year. I think if you look at our diligent of business is very contained, and I don't, logically, it should not have any impact because of Brexit, because it is a necessary service and it's for the policyholders, and that will continue. So I don't logically expect any kind of impact of Brexit on the insurance business we have in Diligenta. But having said that, all the other financial institutions that we serve in a global model, so I don't expect any of the delivery engine or a delivery model to change because of Brexit. The only thing I would watch out for is I don't want uncertainty. A lot of clarity is required. Okay, for example, everyone thought that we'll wait for a few more months before we have a new PM in UK. We already have a new PM. So we'll see how it plays out. What does it mean in terms of whether it is invoking the Article 50, or in terms of free movement of people, or in terms of UK's access to single market in Europe, what it means to institutions headquartered in Europe, operating in UK, headquartered in UK, operating in Europe, headquartered elsewhere, operating in these markets. I mean, all of these things can have implications, but I would say that it need not be only challenges, it can be opportunities as well. So I think we just need to stay focused and then be prepared to react with agility.
But what is your workforce in UK?
So we have a very, we don't split it, we have a very large workforce, but I certainly do not see any impact at this point in time to our workforce, because they're all engaged and we have a lot of requirements, and we have a lot of global people also in UK. So I don't think that there is a risk of any uncertainty on excessive workforce or anything, nothing like that. I think we have a very healthy business, we have a very strong business, we have a very good pipeline, and we have a global model, and absolutely there is no, and we don't deploy, we don't have challenges between using the UK for workforce to Europe or vice versa. There is no such issues we have, because we predominantly use the UK workforce in the UK market and European workforce in the European market, and we don't have too much of movement. So we do not see that kind of an implication for TCS.
So the market correlation that Brexit will be more like a Lehman moment for IT company, because IT companies that derive 25 to 27% of the business from Europe, you think those correlations for the moment are slightly stretched?
Yeah, I would not agree with that correlation at all. The only thing I would say is we have to watch all developments carefully and then react with agility. I will not go to the extent of saying that, you know, it is a situation like a financial crisis. Absolutely not.
Let's talk about the digital business, and we talk about it every quarter. And let me just refer to your commentary, which I picked up along with your Q4 numbers. We are at an inflection point on a digital business. The digital business is growing at 50%. It is a $2 billion business from you. And when the CEO of a company who runs a company which is $16 billion in terms of business, when he says that digital business is the inflection point, that is a tall statement. So I want you to define me the definition of inflection. When you say business is at an inflection point, will it grow at the historical run rate?
See, our digital business, which was 15.5% of the company last quarter, has moved to 15.9%.
Yes.
I have said that digital adoption will be accelerating. Last quarter I said, and I will only re-emphasize and say that statement with more intensity at this point in time, because the proof points are what I said. Whether it is cloud transformation for business agility, or whether it is a front office transformation from a customer journey perspective with all consumer facing businesses, whether it is a telco, whether it is a retail, whether it is an airline, there is a tremendous amount of adoption that is coming, and that's happening, and that will continue to happen. And Internet of Things is real, and even in an industry like retail, there is a huge adoption, and we are seeing projects where we are able to put IoT and big data together and do the analytics to give supply chain visibility.
But if I just put numbers in place, Chandra, digital business is $2.5 billion business. Official data, rare data which TCS shares with us, but this is the official data. Digital business is growing 50%. These are your own words. You are confident that the digital growth is here to stay, which means the business can easily double in 24 months. It could be a $5 billion business for TCS. If it is a $5 billion for TCS, your margins in the digital business are higher than the traditional business. That means your margin trajectory will go higher. Is that where TCS is headed?
There are multiple statements. One is that I will strongly continue to say that the digital business will grow. I won't give guidance, but it will grow at a very good clip. Continue to grow. And it's also true that as the type of engagements, which is a combination of consulting and front office system transformation and large scale cloud transformation happen, I hope to see not only margin uptick, some pricing uptick as well. But at the same time, we continue to make investments.
How much are you investing every year?
We don't give that number. So.
We have a general sense of your cash flows. Your balance sheet is already out. I looked at the annual report. So we can add up the maths there.
We should do that.
Let's talk about the way the entire automation is moving in the IT sector. You're hiring less employees. Digital and automation would mean that the dependence on employees would also come down. Do you think there is a reboot at the cost structure for the Indian IT sector, and especially TCS, given that we are shifting to a new generation of technology?
See, I think there are multiple factors when I say that our headcount addition will be much lower compared to last year. But having said that, we did add a large number of people this quarter. Last year Q1, you have to check the numbers, but roughly we added about 20,000 plus people in gross, and we were about 5,000 to 5,500 people in that range is a net addition. So we had an attrition of 15,000 people. This year our net addition is about 8,700, 8,800. Our gross addition is about 17,000. So the gross addition has come down, net addition has gone up. So definitely the attrition management will play a big part in our reduced hiring as well. The second point is automation and other things will play a part, but that will be fairly long term. It is not next quarter.
But if I have to summarize today's interaction, your view is that the pain points which had haunted you in FY16, whether it was LATAM or volatility within the India business or the problems which you had in the energy and telecom vertical, they are behind us. The problem points are only two: Japan and Diligenta.
See, I think the way I would put it is that Japan continues to decline. This quarter also we had a degrowth. Diligenta is flattish. And flattish to practically flattish, and it will continue to be so. We won't see a big uptick. Latin America has been flattish. Last quarter it delivered a very strong growth. This quarter it's flattish, and hopefully it will grow from here. So some volatility will definitely exist. See, India will be volatile. India
it's unreal to see that kind of growth in India.
8.5%. The team has done a fabulous job. I mean, I'm very, very happy the way they've been able to pull it off. But then I also want to stress that India will be volatile. So Latin America has been volatile. But the point is that the volatility should remain in the positive trajectory. It's one growth at this level and growth at this level is fine. We don't want a growth degrowth scenario. So I hope that we will continue to grow in all these markets. and some will be at a lower trajectory, and some quarter will be at a better trajectory. But Japan continues to be a challenge.
You know, my primary job is to get a headline from you. Your primary job is not to give me a headline.
Yeah.
So why don't we just fill in some blanks? For FY17, Chandra is excited, he is curious, or he's confident?
Chandra feels TCS has started well in Q1. Is watchful of the macro developments, but no cautionary statement from any customer perspective. The known problems are shared with you.
Why is your body language telling me that FY17 will be better than FY16?
No,
That's my assessment of your body language.
You're reading. You're reading.
Sometimes it's important
no,
reading
we have to
between lines.
factor in all the aspects, like, we had a sometimes you have a better exit, sometimes you don't have a better exit. So on a yearly perspective, you need to also take into account what is the exit at which you left. And
FY16 was the lower exit, and then it started higher.
So we started.
But it started FY17 higher.
No, FY17 is Q1 is good, but the exit was not as good. So we need to climb from here, and we had a huge cross-currency impact last year on the dollar. But this year, actually, in the first 2 weeks of July, we have seen a huge appreciation or strengthening of the rupee against both British sterling and the US dollars. So we've got to watch those things, and those things will be headwinds. And also, you have an issue with regard to UK. We have about 13% of our revenues coming from UK, and already it has strengthened 10%. Or more. So we need to watch all these things, but I'm happy overall from the business perspective where it is.
So how would you say Q1 was different from Q4?
I mean, in all perspectives.
All perspectives. Yeah. The client engagement is getting better.
Yeah, client engagement is good, and footprint is good, very broad based, and the quality of engagement is good. And see the number of verticals in which we have delivered a very good growth. I mean, very many verticals.
There is no pricing power, is my understanding about the business.
Yeah, I think we have been more or less flattish on pricing.
So, Chandra, closing comments from you, and I promise I'll not extend my interview after this, even though you're speaking first to us. Let's talk about the industry per se. Do you think now it's time to reassess the growth rate for the Indian IT sector per se? It's not going to be in late teens, it's going to be early teens. Big companies may grow at a run rate which could be higher than the industry average, but in general, the growth rates are coming down.
Can't say that because it depends on several factors. A lot of things have to come together to deliver high growth. Okay, one is the market opportunity, and everyone will agree with me that technology is in the forefront, right and center of every business, and the digital transformation is key, whether you are in a manufacturing sector or in a consumer sector. And so the amount of money that's going to be spent on technology, both on a simplification side and also on the transformation side, is going to be huge. So opportunity is there, but all the other factors with respect to every company, whether they are going to be able to continue those investments or they are going to watch, etc., from the customer spend point of view, will vary from company to company, market to market, and the macro. That's the second perspective. The third one is that what are all the other headwinds, whether it is a visa or other regulatory environments we need to look for. And from our point of view, we can only look at how well we can be prepared. So we should not be worrying whether it happens in FY17, FY18, but we need to be prepared and be in a state of readiness. Whenever there is a big uptick and big opportunity, we should be able to work with customers to capture. So that's the way I approach it.
Let me just close the show with a comment from you from today's press conference. There is agility in the business. I'm confident and excited about what our clients are doing. So you've set the bar higher clearly for competition and for your peers. Thank you for joining us, and thank you for patiently answering all our questions.
Thank you.
Thank you very much.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.